This chapter switches gears from the defensive investor to the enterprising investor, someone willing to do more homework, accept more risk, and try to beat the market by picking individual securities or special situations. Graham begins with a clear-eyed warning: outperforming broad market averages over long stretches is hard. He points out that even professional mutual funds with research teams and resources often fail to beat indices. That reality forces us to ask why stock picking is so difficult. Graham suggests two main explanations. First, maybe the market already reflects all sensible information about a company's prospects, so price moves are mostly driven by unpredictable, genuinely new events, which makes forecasting effectively random. Second, analysts may be biased toward buying the best businesses at any price, so they overpay for growth while ignoring cheaper, ordinary businesses that in time rebound. If lots of smart people chase the same stories, the bargains move away. So what does a thoughtful, enterprising investor actually do? Graham describes the approaches that made his own firm successful, but warns these are not for casual dabblers. The Graham-Newman playbook focused on a few categories: arbitrages, merger deals, buying a security that will be exchanged in a merger, and shorting the stock that will be issued. Essentially a deal bet with a calculable payoff. Liquidation plays, buying stocks of companies undergoing liquidation or planned cash distributions where the payout is likely higher than the market price. Related hedges, buying convertible securities while shorting the common into which they could be converted, limiting downside while keeping upside if markets move strangely. Net current asset, bargain issues, buying stocks for less than their net current assets, working capital, such as paying under the stripped-down balance sheet value and ignoring plant or goodwill. Graham emphasizes heavy diversification here, dozens, even 100 small positions, because many such bargains are cheap for reasons that matter. He also shows how to use a serious screening method, using the Standard & Poor's stock guide in his example. Start with low P/E ratio issues, then apply looser versions of the defensive filters: minimum current ratio, no recent losses, some dividend, earnings higher than 5 years prior, and price below a percentage of tangible assets. That winnowing reduces thousands of names to a manageable set of candidates. A practical approach to find underappreciated secondary companies, the kind that in Chapter 13 were Eltra and Emhart. Graham tests many single-criterion strategies: low P/E ratio, high dividend, big size, quality rankings, etc., and finds mixed results. Pure random lists do poorly. The best single-factor results came from high-quality industrials and, oddly, the goodwill giants. Large popular firms with major intangible value performed well in that period. Importantly, the classic net current asset bargains historically produce strong returns, but you must be patient and diversified, because results can take time. Graham's consistent advice: these situations can yield high returns, but they're essentially a profession. You need experience, diversification across many deals, the ability to analyze terms, and the discipline to accept many small disappointments to capture the occasional large gain. The commentary brings the chapter into today's world and gives actionable investor advice. Practice first, paper trade, or run a simulated portfolio for a year before risking real money. That teaches discipline and reveals whether you're any good at stock selection. Limit exposure. If you want to pick stocks, keep it small, say 10% of your total portfolio, and make a broad index fund the core. Most people should stop there. Use modern screens and metrics. In addition to P/E ratio and price to book, look at ROIC, return on invested capital, and owner earnings to see how efficiently a company turns capital into cash. Hunt in the right places. Good ideas often come from the list of 52-week lows, former darlings that have fallen out of favor, or businesses with rising ROICs. Study management. Owners-minded managers who communicate transparently, avoid abusive option dilution, and put capital to good use matter. Learn from pros. See what successful value managers hold and read their letters: Buffett, Davis, Nigrin, Draymond, etc. Their emphasis: discipline, patience, and thinking like an owner. If you want to be an enterprising investor, you can, but expect hard work and modest odds. The routes that historically worked for Graham: Bargains, workouts, related hedges require discipline, diversification, and patience. For most people, a small, active sleeve plus a broad, low-cost core is the sensible compromise.